here we go. Let's move into asset liability management. Most lending institutions experience a positive maturity gap between the average maturity of their assets and the average maturity of their liabilities. This is the nature of banking. What do I mean by that? This means that loans typically have a longer term than deposits. Deposits typically are shorter term, loans are longer term. In other words, we say that banks borrow short, deposits, and lend long, loans. Okay? Typically, financial institutions that focus on lending, i.e. banks, have higher net interest margins with an upward sloping yield curve. With a normal yield curve, okay, banks have better interest margins. Why? Well, if the yield curve is upward sloping, revenue from long-term assets, which is loans, will outstrip expenses from short-term liabilities, which is deposits. Remember, banks pay short-term rates on deposits, but they charge long-term rates on loans. And the spread between long-term rates that they get on loans and short-term rates which they pay on deposits is their profit margin. Okay? In contrast, a flat or negatively sloped yield curve often generates a small or an even negative net interest margin. Okay? Let's take a look. So there are two ways to show the spread between longer term rates, the 10-year treasury, which is the dark line, and shorter term rates, which is the lower line, the 3-month treasury. Okay? That is, so you got the actual level of rates, and you can see these gaps. A big gap, a small gap, a big gap. The larger the gap, the larger the spread. The larger the spread, the higher the profit margin is for banks. Okay? The net interest margin. All right. This line here is the 10-year minus, the rate on the 10-year minus the rate on the 3-month treasury. So there's only one line here. So when it's high, when this line is high, that indicates that the spread is high, right here. And when this line is low, it indicates the spread is low. High profit margin, low profit margin. Okay? Ooh. Need to fix that. I thought I had all my animation right. All right. Now that we understand the basics of interest rates, I will remind you that changes in interest rates affect both the balance sheet and the income statement of banks. The balance sheet is affected because the values of assets, liabilities, and owner's equity change when interest rates change. The income statement changes because interest income and interest expense both change. There are many departments in a bank that make decisions regarding assets, like what loans to make, how long terms should be on those loans, what rates should be on those loans. And those people who make decisions about liabilities, like what rates to pay on deposits and on CDs. Management should have a comprehensive approach to these decisions because all of these decisions together affect the interest rate risk that a bank has. In other words, you cannot have these banks making decisions in isolation of each other. The folks who are making lending decisions need to be communicating with the people who are setting rates on CDs and deposits. They need to be communicating to discuss the profit margin of the bank, the spread. And so we call this approach of being aware of and of managing the spread, we call that asset liability management. Managing both the assets and the liabilities of a bank. All right, asset liability management has two goals: So the balance sheet's impacted and the income statement is impacted, and you have one goal for the balance sheet and one goal for the income statement. Okay? So for the income statement, the goal is protect the profitability of a bank. You don't want changes in interest rates to damage your profitability. Number two, protect the capital of the bank, the owner's equity of a bank. You don't want changes in assets and liabilities to wipe out your capital. That's what happened in 2009. The assets, the loans, the mortgage loans, and the investments in mortgage securities, the assets went down in value. The liabilities did not. If your assets go down and your liabilities stay the same, your owner's equity is damaged. And that's what happened. All right. Before we dive into the details about how asset liability management is done, there's a basic reality that we should acknowledge. And that reality is that no one can consistently forecast interest rates. If people could forecast interest rates successfully, accurately, then managing assets and liabilities would be a snap. The best economists in the world cannot consistently forecast interest rates. It just doesn't happen. Why? Just like for the stock market, you have millions of people interacting, and together the market is smarter than any individual in the market. All right. So this table shows the percentage of professional investment managers who hit their interest rate forecast. There we go. So 16%, this is over a 5-year period of time. For short term, pretty good in this category, 61% over a 5-year period of time, 25% for non-taxables. So you can see that the number of managers who correctly forecast interest rates for this 5-year period of time was pretty doggone low. And the people who are successful over this 5-year period of time, and let me tell you, the 1-year chart is much worse. Much worse. It's half of this. And nothing gets over like 25%. Okay? This is proof that people cannot forecast interest rates. So if you cannot forecast interest rates, and people try all the time, if you cannot forecast interest rates, then you have to hedge interest rates. You have to take actions and devise strategies in order to manage interest rates. All right, so to protect the profitability of a bank, management must first deal with the major income and expense items that banks have. Okay? These items are interest income and interest expense. What we focus on is the net interest spread, the NIS, and the net interest margin. Okay? The NIS, net interest spread, is the average yield on assets minus the average yield on liabilities. And of course, we want this to be high and this to be low and the difference to be high. That's our profit margin. This is our income, this is our expense. The net interest margin is income from loans and securities minus interest expense on deposits and bank debt divided by total earning assets. We do this so that we can compare banks of different size. Net interest income is this minus this. Net interest margin is this minus this divided by total assets. So these are the things that we're looking at, particularly the net interest margin. Okay? The goal is to insulate or hedge the net interest margin against moves in interest rates that could impair it. We will see that in some environments, if interest rates go down, that's bad for banks. In some environments, if interest rates go up, that's bad for banks. So we'll take a look at all the different things that can happen. All right, and it just makes you aware that managing a bank is a tricky thing. All right. So the issue arises because changes in interest rates are not the same for deposits, which are short-term, and for loans and securities, which are long-term. So often, when interest rates change, they'll change at one speed for your loans and securities, but at a different speed for your deposits. Okay? So changes in rates could cause the spread between interest income and interest expense to narrow. And that is what we're trying to protect against, a narrowing of the net interest margin. That's how we protect the income statement. That's how we protect the profitability of a bank managing the spread or the margin. Okay? And that would harm the profitability of a bank. All right, as an example, say the slope of the yield curve flattens. This means the spread between long-term and short-term rates narrows. This could happen because short-term rates rise because the Federal Reserve makes that happen, and long-term rates don't rise at all, or maybe they don't rise by as much. Or the spread could fall because long-term rates fall and short-term rates don't fall, or they don't fall as much. Okay? So the yield curve, when it moves, it doesn't move 1% for short-term rates and 1% for long-term rates. Often, the yield curve slope will change. Okay? And when that slope changes, the spread changes. And when the spread changes, a bank's profitability either gets hurt or it improves. Okay? Either way, what happens is the cost of deposits rises here, the spread narrows, relative to the earnings on loans and securities. So what you earn on loans and securities is not as excessive over the cost of deposits. Okay? This causes net interest income to decline, so the profitability of the bank would be hurt. Now sometimes there's an opposite move, where long-term rates go up, short-term rates don't, or they don't go up by as much, and that helps the margin. All right. But managing the spread is more than just watching the yield curve. Okay? The net interest margin is complicated, and it is influenced by multiple factors. So let's take a look at what also impacts the net interest margin. Okay? First, as we said, the yield curve rarely moves in a parallel manner, which what this means is that rates for the various maturities change at different speeds. Okay? So the slope changes. So short-term rates might change more or less than long-term rates. Since banks borrow short and lend long, if the yield curve does not change in a parallel manner, the spread between asset yields and liability costs will change. Changes in the ratio of the dollar amount. So now, how much you have in assets versus how much you have in liabilities affects the spread, the margin. How much you have in short-term assets versus how much you have in long-term assets versus how much you have in liabilities affects the spread. So the margin. So you have the spread, the difference in rates, but you also have the dollar amount invested in all of those things. What if you had all of your money in one-year loans and the one-year rate is what was being paid on deposits? Your margin would be 0. Okay? But what if you had 10 times the amount invested in assets than what you had in liabilities? All right? Then even though the rate is the same, the interest income on your assets would be 10 times higher because you had 10 times more money invested in the assets. So it's not just the spread or the rate of return, it is also the dollars invested. Okay? All right? Getting a little complicated. This is really interesting stuff, folks. All right. The mix of assets and liabilities that have floating and fixed rates will also impact a bank's net margin. Another complicating factor. So you have the total dollars in assets, the total dollars in liabilities, the total dollars in invested in short-term assets and long-term assets versus the total dollars invested in short-term deposits. Most deposits are short-term. But then you have some assets that are floating rate and some that are fixed rate. And you have some liabilities that are locked in longer term, like a CD, and some liabilities that float with the market, like a checking account. For example, say a bank has a higher dollar amount of floating rate assets than floating rate liabilities. This means if interest rates rise, the earnings on assets will rise faster than the cost of deposits. Because floating rate means that the rate follows the market. So if market rates go up and you have more assets invested in floating rate, then your asset earnings go up by more than your liability expense, and your margin widens. Okay? If rates fall, the opposite will happen. Your net interest margin will shrink because your earnings on your assets will fall faster than your earnings on your liabilities. Okay? So it depends on how the bank is positioned. If a bank has a smaller ratio of floating rate assets versus liabilities, if rates fall, so now we have a smaller ratio, if rates fall, income will fall less on your assets than costs will fall on your liabilities, your deposits, so that NIM will improve. So it depends on what your mix looks like between floating rate and fixed rate. Okay? The opposite would happen if rates rose. The net interest margin would contract or shrink. Okay? The difference between the dollar amount of floating rate assets and liabilities is called the interest sensitive gap. So we have to compare the dollar amounts invested in assets, the dollar amounts invested in liabilities, the dollar amounts invested in short-term assets and long-term assets and short-term deposits, and the dollar amounts invested in assets that reprice or float and in liabilities that reprice. Okay? Really cool stuff. All right, the interest, so we call this the ISG, Interest Sensitive Gap Management. Managing the gap. If you have the same dollar amount invested in floating rate assets and in floating rate liabilities, then your margin will not change. All right? But if there's a discrepancy, if you have more floating rate assets than floating rate liabilities and interest rates go up, then your margin will improve. If interest rates go down, your margins will deteriorate. All right, so you have to do an analysis of the maturities and of the repricing opportunities associated with assets and interest-bearing liabilities. So repricing means that you can reset the interest rate, either up or down. It means that the interest rate on the loan or security or deposit will move with the market. How often can you reset? To reduce interest rate risk, management will try to match as closely as possible the dollar volume of assets and liabilities that can be repriced over a certain period of time as interest rates change. You try to match up the same dollar amounts that can be repriced. Examples of repriceable assets, it means you can reset their interest rates, include short-term loans. Okay? They're short-term, so they will mature in the near future, and when they mature, you can reset or reinvest the money at a higher rate if interest rates go up. Revolving lines of credit typically have floating interest rates. Short-term securities, same thing. You buy a short-term security so that it matures soon and you can reset it. You can buy a new, reinvest your money at the newer rate. Loans with short renewal schedules. So the bank says, I'm going to give you a 20-year amortization, but we're going to reset it, the rate, every 6 months. And any loans that are maturing, you might have a 30-year loan that's been on the books for 29 and a half years. That is now a 6-month loan. Okay? Long-term loans and securities that do not have floating rates, that do not reprice. So those are the items that don't reprice and you're locked in. Repriceable liabilities include federal funds. They're very short term. The rates change all the time. Federal funds borrowed. Deposits are repriced all the time. Okay? CDs that are maturing shortly, short-term CDs. Savings accounts and checking accounts. Okay? These things are repriced all the time. Almost all of your liabilities except for bonds reprice over the short term. It's tougher to get your loans to reprice. You can buy short-term securities. It's pretty easy to adjust that. Where banks have gotten much, much better with their loans, repricing their loans more quickly. All right. Long-term bonds that a bank issues to borrow money that have fixed rates do not reprice. So you have repriceable assets and repriceable liabilities. All right, a financial firm can hedge itself against its interest rate changes no matter which way rates move. And again, some people like to think that they can forecast that interest rates are going to go up or go down. The data just doesn't support that. So if you cannot forecast, you hedge. Okay? By making sure that for each time period, the dollar amount of assets that reprice equal the dollar amount of liabilities that reprice. Okay? So you can see that already we've done a few calculations and we're getting ready to do more calculations. They're not that difficult. I'll let you bring in a card, but we're going to have to do some calculations. So let's look at what we call the interest-sensitive gap. Okay? The interest-sensitive gap is the dollar amount. It's interest-sensitive assets, the dollar of interest-sensitive assets, the dollar value, minus the dollar value of interest-sensitive liabilities. It's a dollar amount. Okay? The gap is that portion of the balance sheet that is affected by changes in interest rates. This will move at the same rate as this, basically. But the difference between the two is what will impact a bank if rates change. Okay? So what banks have to do is be aware of that gap and manage that gap. This gap should never be an accident. It needs to be managed. All right, if interest-sensitive assets exceed the volume of interest-sensitive liabilities that are subject to repricing, then the firm is said to have a positive gap. It is said to be asset sensitive. It is driven by assets. Okay? Asset sensitives. So assets, asset sensitive assets, interest sensitive assets are higher than interest sensitive liabilities. Okay? So the question is, in this case, well, let's make sure. If a bank is asset sensitive, that means the net interest margin will expand when interest rates